Here is a paradox that catches most retirees completely off guard. The year you retire is the year your tax return becomes the most complicated it has ever been, not the simplest. You would think that the year you stop working is the year your taxes finally get easy. One less W-2, one less daily commute, one less everything. But the year you retire is the year 7 different types of income can all show up on the same return, from sources you have never dealt with before, reported on forms you have never seen, with deadlines you have never had to meet. And the IRS, which has spent decades building automated systems that match what you report against what third parties report about you, is very, very good at catching what you leave off. This isn't about fear. This is about the honest reality that a first retirement tax year has more moving parts than any working year ever did. Your last paycheck, your first Social Security deposit, a partial pension, maybe a 401k rollover, possibly some unused vacation time paid out, a 1099-R you didn't expect, health savings account reimbursements, severance. Each of these is its own entry, its own form, its own line item, and each has to land in the right place on Form 1040 for everything to reconcile properly. This video is for educational purposes only and is not personalized tax, financial, or legal advice. Consult a qualified professional for guidance on your specific situation. What I want to walk through today are the 7 categories of income and reporting obligations that retirees consistently miss or mishandle in their first retirement year. The kind of oversight that turn into IRS notices 6 to 9 months later, when everything is harder to fix. Walter retired in August of his 66th year. He had been an electrician, IBW Local 38 out of Cleveland, for 43 years. His last day was a Friday. He cleaned out his locker, shook hands with the apprentices, and drove home. He thought he knew what was coming. His pension would start. His Social Security would kick in a few months later because he had chosen to wait. His 401k was going to sit for now. His wife Eleanor, a retired nurse, had already been drawing on her own pension for 2 years. Simple, right? His tax return that April had 7 different sources of income on it. His final wages, his unused vacation payout, 2 months of pension, 4 months of Social Security, a 401k distribution he had taken to pay off the truck, a state tax refund from the prior year, and a 1099-R for a life insurance policy that had matured and paid out accumulated dividends he had forgotten existed. His preparer found every one of them. But when Walter tried to do it himself first, he missed 3. And the 3 he missed, if he had filed without catching them, would have generated a matching notice from the IRS automated underreporter system called AUR within about 10 months, along with interest, along with penalties, along with a headache. Let's walk through the 7 categories, one at a time, with the kind of detail that actually helps you spot them on your own return. The first is your final wages and any associated payouts from your former employer. Your last W-2 will include your regular wages through your last day, but it also often includes things you don't expect. Unused vacation time, often paid out as a lump sum. Unused sick leave in some jurisdictions. Bonuses that vested on retirement. Stock grants that accelerated on separation. Deferred compensation that paid out because the plan document required it at separation from service. Retention bonuses paid on your final day. All of that flows through your W-2, which means your federal withholding on that final paycheck may or may not match what you actually owe. A large lump sum paid on the last day is often taxed at the 22% supplemental withholding rate, which can be far below your marginal rate if you are in a high-income year. That becomes an underpayment risk. The second is Social Security benefits. The year you begin collecting Social Security, you will receive a Form SSA 1099 in January reporting the gross benefits paid. Up to 85% of those benefits can be federally taxable depending on your provisional income. Provisional income is calculated by taking your adjusted gross income, adding back tax-exempt interest, and adding half of your Social Security benefits. For a single filer, if that number exceeds $34,000, up to 85% of your Social Security becomes taxable. For married filing jointly, the threshold is $44,000. Those thresholds were set decades ago and have never been indexed for inflation, which is why more and more retirees find their Social Security significantly taxed. You can elect withholding on Social Security by filing Form W-4V with the Social Security Administration, choosing 7, 10, 12, or 22% withholding. Most retirees either do this correctly or don't do it at all. The middle ground, under withholding, is where penalty trouble starts. The third is pension and annuity income. Your former employer, or the insurance company administering an annuity, will send a Form 1099-R each January. The gross distribution is in Box 1. The taxable amount is in Box 2A. Box 7 has a code that tells the IRS what kind of distribution this is, whether it is normal, early, death, disability, or something else. If you have a pension with after-tax contributions, meaning you paid taxes on some of the money going in, part of each payment is a non-taxable return of your basis. The calculation uses the simplified method from the 1040 instructions and publication 575. Most retirees get a partially correct Box 2A from the custodian, but if the basis calculation wasn't set up properly, you may be overpaying or underpaying. This is worth a careful look. The fourth is IRA and 401k distributions, also reported on Form 1099-R, also with a Box 7 code. If you took a distribution before age 59 and a half, you might owe the 10% early withdrawal penalty unless an exception applies. If you took a distribution after age 59 and a half, but before your required beginning date, it is a normal distribution, but still fully taxable if it came from a traditional account. If you rolled over a distribution within 60 days, that is reportable but not taxable, provided you deposited the same gross amount into the new account. Watch the 20% mandatory federal withholding on an eligible rollover distribution that is paid to you rather than rolled directly. If you only deposit what you received after withholding, you've technically taken a taxable distribution equal to the withheld amount. Helen, a retired postal worker from Pennsylvania, ran into this. She took a $50,000 distribution from her TSP, intending to roll it into an IRA. The TSP withheld $10,000 for federal tax. She deposited $40,000 into her IRA within 60 days. She thought she had rolled the whole thing. She had actually rolled $40,000 and taken a $10,000 taxable distribution. She would have needed to add $10,000 of other money into the IRA to make the rollover complete. The $10,000 became taxable, and at her marginal rate, added about $2,400 to her tax bill. The fifth is investment income that looks different in retirement. When you retire, you may start drawing from a taxable brokerage account for the first time in years. Every sale of a security generates a 1099-B, which reports proceeds and cost basis, which reports if your broker has accurate cost basis for covered securities. This flows through smoothly. For non-covered securities, meaning anything held before 2011 for stocks and 2012 for mutual funds, you may need to dig up your own records. A missing cost basis defaults to zero, which means the entire sale is treated as a capital gain. That can inflate your tax bill by thousands. Retirees often discover old stock certificates, old mutual fund positions from the 1980s and 1990s, and the cost basis becomes a research project. Dividends go on. Form 1099 Div. Interest on Form 1099 INT. Tax-exempt interest from municipal bonds still has to be reported because it counts in the provisional income calculation for Social Security and in the modified adjusted gross income calculation for Medicare-era A. Tax-exempt doesn't mean invisible. The sixth is health and benefit-related items. Your former employer may have paid out a lump sum from a health reimbursement arrangement or provided retiree medical benefits whose value gets reported. Your health savings account, if you have one, allows tax-free reimbursements for qualified medical expenses. But if you took a distribution for a non-qualified expense, that is taxable and possibly subject to a 20% penalty if you are under 65. If you became eligible for Medicare mid-year, you may owe a partial year HSA contribution penalty if you contributed the full annual amount. Medicare enrollment disqualifies HSA contributions going forward. And the 6-month retroactive enrollment for Part A, if you delayed Social Security, can trip retirees up in the HSA contribution calculation. The 7th, and the one most retirees genuinely don't know about, is what the IRS calls miscellaneous income of various kinds that shows up once in a retirement transition. A state tax refund from a prior year in which you itemized. A cash bonus from a bank account open to receive your direct 1099 INT from banks, 1099 divvy from mutual fund or brokerage accounts, 1099 B from brokerages for any sales, 1099 NEC from any client you did consulting for, W-2 from your final employer, 1099 MISKI for anything that doesn't fit elsewhere. If your list and your forms don't match, you are either missing a form or you have income that didn't generate a form. Both need to be reconciled before you file. Next, think about estimated taxes. When you were working, your employer withheld federal tax from every paycheck. Once you retire, unless you elect withholding on your pension via Form W-4P and on your Social Security via Form W-4V, you may have no withholding on a large portion of your income. The IRS expects you to pay as you go. If you don't, Form 2210 computes an underpayment penalty. Safe harbor is generally meeting either 90% of current year tax or 100% of prior year tax. 110% if your adjusted gross income was above $150,000. Estimated tax payments are made quarterly using Form 1040 COEs, with deadlines in April, June, September, and January of the following year. Most retirees underestimate their first year. They assume retirement income is lower, so tax is lower. But a first retirement year often has both wages and retirement income, plus a lump sum 401k, distribution to pay off a debt, plus the start of Social Security, plus maybe a capital gain from selling a rental property. Income can actually be higher than the working year it followed. Consider withholding as your default. The easiest way to avoid underpayment penalties is to have enough withheld from your pension and Social Security that you meet the safe harbor. Form W-4P lets you specify a withholding amount or percentage from pension income. Form W-4V lets you specify 7, 10, 12, or 22% from Social Security. Set these up early in the year, review them after 6 months, and adjust if needed. Be deliberate about large one-time events. If you're going to take a big 401k distribution, do it in a year where your other income is controlled. Don't stack a big distribution on top of final wages. If you are going to do a Roth conversion, do it in a year where your bracket has room. Don't convert in the same year you retired if your wages already pushed you into a high bracket for that final work year. Watch the Medicare IRMA impact. Your 2024 Modified Adjusted Gross Income determines your 2026 Medicare premiums. A first retirement year with a high income because of a lump sum can cost you hundreds of dollars a month in elevated Part B and Part D premiums 2 years later. Plan distributions with the look back in mind. Review state tax obligations. If you retired mid-year in one state and intend to move, the state where you earned wages still has a claim on those wages. Your part year return will need to allocate income accordingly. If you retired and stayed put, your state return should look similar in structure to prior years, but with different line items. File Form 8822 if you moved. The IRS sends notices to the address on file. A missed notice becomes a much bigger problem than a notice responded to on time. Beatrice, a retired librarian from Minnesota, did her first retirement year return herself using software. She correctly reported her final wages. She correctly reported her partial Social Security. She correctly reported her pension. She missed a 1099-R for a small variable annuity distribution of $4,000 because the form arrived in late February, after she had already filed in early February. The IRS AUR system matched the 1099-R to her return about 9 months later. Sent her a CP2000 notice proposing additional tax of about $960 plus penalty and interest. She filed Form 1040X, agreed to the proposed change, paid the additional tax, and moved on. Not catastrophic, but entirely avoidable if she had waited 2 more weeks to file, or set up a simple reminder to check all 1099-R forms before filing. The broad lesson is this. Your first retirement year is not the year to rush the tax return. It is the year to be slow, methodical, and thorough. Gather every form. Reconcile every income source. Make sure withholding or estimated payments meet the safe harbor. Pay attention to the Medicare IRMAA 2-year look-back. Don't assume income is lower just because you stopped working. The IRS has a matching system that catches missing income automatically. You will not outrun it. The goal is to report accurately the first time, so the letter never comes. Most retirees, honestly, are not trying to get away with anything. They just miss forms because they have never had to deal with that particular form before. The 1099-R from an old insurance policy. The 1099 INT from a brokered CD they forgot had matured. The 1099-B from a mutual fund position they sold to rebalance. These are all legitimate, reportable income events, and the IRS already knows about them because the payer already filed the matching document. If you want to do this right, work with a qualified tax professional in your first retirement year. Not forever, just for that transition. The professional will ask the questions you might not know to ask. They will look at every account, every form, every income stream, and help you file cleanly. In subsequent years, your return will stabilize and become more manageable. The first retirement year is the expensive year to get wrong and the worthwhile year to get right. Before you head off, tell me in the comments which of these 7 categories surprised you, or which one you or someone you know has been tripped up by. Real stories from real retirees help other viewers see what to watch for in their own first retirement year. Your comment might be the exact thing that saves another viewer a $1,000 IRS notice. And if you know someone whose last day at work is coming up in the next few months, go ahead and share this video with them. A 15-minute watch now could save them months of paperwork later. Take care of yourself. Take care of your people, and I'll see you in the next one.